Happy Thanksgiving to you and your family. My name is Alvin, and this is the Wealth Indicators channel, where people come to discuss all things personal finance. Today, we'll be talking about individual state income taxes. According to the Tax Foundation, this category of taxation accounts for about 40% of the taxes that states collect. Also, although it is not discussed as often as its federal counterpart, a sizable portion of your earnings can go to this state financial obligation depending on the jurisdiction you live in. In 1901, Hawaii became the first United States territory to impose an income tax on its residents. However, Hawaii did not become a state until 1959. So as a result, the first state to do it was Wisconsin in 1911. The majority of U.S. states enacted legislation to start imposing income taxes in the 1930s. There are currently 7 states in the Union that do not have a state income tax. They are Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming. Also, New Hampshire and Tennessee do not tax earned income. However, both of these states currently have a tax assessment on interest and dividend income. But New Hampshire and Tennessee are currently phasing out those taxes, and by the end of 2025, they should also be tax-free. After that occurs, there will be 9 states without an income tax in the United States instead of 7. For the states that have an individual income tax, there are 2 main systems they use to collect those taxes. They either choose to go with a graduated rate system or a flat tax. The majority of states and the District of Columbia currently use a graduated system. So with a graduated rate system, states have multiple tax brackets, and once your income exceeds the threshold for one bracket, you graduate to the next one, where your next batch of income is taxed at the next higher bracket, similar to the system used to tax income at the federal level. An example of this is California's tax collection system, which currently has 9 brackets with the lowest rate of 1% and going as high as 12.3% as of 2023. An example of the flat tax would be in my state, Arizona, the Grand Canyon state, which recently changed its method of taxation from the graduated to a flat rate system. With the previous graduated system, there were 2 tax rates. Taxpayers were assessed a 2.55% tax rate on income of $28,653 or less, and a rate of 2.98% for income of $28,654 or more. After the change to a flat rate, starting in the 2023 tax year, there will be one flat rate of 2.5% regardless of your income. Taxation is a complex subject, but knowing the fundamentals about how federal and state governments tax your income is essential because it allows you to have intelligent conversations with tax professionals, and it also gives you the option to structure your income in a tax-efficient way. Pick up your copy of my book, The Wealth Indicators, on Amazon today. And if you think this information is valuable, like and share this video with anyone you know who would be interested. Leave a comment or question if you have one, and follow the channel for more ways to improve your financial life. May the best of your today be the worst of your tomorrow.